welcome to our Get Started video series. In this video, we will decode common terms you may encounter while embarking on your mutual fund investing journey. This jargon may sound daunting to you at first, but once you understand it, it becomes quite simple. So, let's start. The first and the most basic terms are direct plans and regular plans. Each mutual fund scheme has two options, regular and direct plans. Let's use a simple analogy to understand them. Say you want to rent or buy a house. You have two options. Either you find a house on your own or approach a broker to help you out. If you choose to go through a broker, you must pay a commission to the broker for their service. It's similar when you invest in a mutual fund. There are distributors and brokers who can help you with each stage of mutual fund investing. In return, you are required to pay a fee to them. These mutual fund schemes are called regular plans. But if you are net savvy and don't need any hand-holding, you can opt for the direct plan. Here, you have to handle everything, from doing the formalities to making investment decisions. Since you avoid paying the distributor fees in the direct plan, they give you higher returns than the regular plan over the long term. Now let's look at the next two terms, growth plan and income distribution cum capital withdrawal plan. Within both regular and direct mutual fund schemes, you can also choose between the growth plan and the income distribution cum capital withdrawal plan. Your choice of plan decides how returns get distributed to you. Let's understand them one by one. In the income distribution cum capital withdrawal plan, a portion of the profits earned is paid out to you from time to time. Some people mistake it to be an extra return like a dividend, but do note that the distributions under IDCW are not over and above the gains made by the fund. However, we don't recommend this option because the quantum of payout and timing is as per the choice of the fund house. The amount paid out is subject to income tax because financially it's similar to withdrawing money from the fund. You lose the advantage of compounding on the amount distributed. The other option is to go with the growth plan. In the growth plan, the gains made and dividends received are reinvested back into the scheme. This way, your investments grow faster over time. Hence, you should always go with the growth plan. Expense ratio. Expense ratio is the fee you need to pay mutual fund companies to manage your money. Just like you pay a lawyer to manage your legal matters, a chartered accountant to help you file your tax returns, and an architect to design your house, mutual fund managers charge a fee for building and managing your investment. This fee includes your broker's commission if you decide to go with a regular plan. Thus, the expense ratio of regular plans is higher than that of direct plans. Net asset value or NAV. When you invest in a mutual fund scheme, you are allotted units that represent your share in the assets of the fund. Now, the amount you need to pay to buy a unit of a fund or the amount per unit that you would get while redeeming a fund is called its NAV. Mathematically, it is the market value of the fund's portfolio divided by the number of total units held by its investors. NAV is often referred to as the price of the fund. But that's a bad interpretation that leads to a misconception that a lower NAV is better and means you are buying cheap. The purpose of NAV is to evaluate a fund's performance by comparing its present NAV with its past NAV. Lower or higher NAV on a standalone basis has nothing to do with the fund's performance. Assets under management or AUM. Mutual funds invest in equities, bonds, and other such instruments. If you add the market value of all the investments made by the mutual fund along with any idle cash that it holds, the final tally is called AUM or assets under management. AUM can increase or decrease in two ways: when more people invest or exit the fund, and when the mutual fund's investments rise or fall in market value. Thus, AUM tells you how large or small a particular fund is. That's it for today. We hope this video helped you understand a few important mutual fund terms that you must know. Check out our other videos for simple and interesting explanations on mutual funds. These 12-part videos are all that you need to know to get started with investing in mutual funds. Bye for now. Happy investing!